Hi guys, thanks for joining. Today I want to talk to you about financial statements for businesses. So whether that's a business you're looking to acquire or perhaps a business that is a listed share on a stock market. Very similar in the way that what you'll be looking for, depending on obviously your style and what you're actually looking to purchase. For example, today I'm going to be talking about something that generates you income long term, rather than something that you're buying for assets or some other reason. So basically we're looking for something that is going to generate us income long term. Potentially we can grow it, it's hopefully going to be stable, but most of all it's going to be profitable overall. So let's jump into it. We're going to start off with income. So income is very important. You ideally want the income to be quite large. With that income, you want to check its consistency. You want to also check, is this a type of income that they might be receiving once off? Where is that coming from? Is it stable? All of those types of things. So you want to understand really about how the income is produced and how consistent is it. Can you keep repeating that process of generating that income if you were to take over that business, or will it keep going if you buy shares in that business? You might come across some businesses that receive a grant or a government grant for research and development, for example, and that might be a once-off payment. They might not get that income again. So it's important to consider this when you're looking at the income part of the financial statements, such as the profit and loss. So if you see a heap of research and development type incomes, just be sure to check, will that come through next year and the year after that, and on an ongoing basis, because it could just be a large amount that's a once-off and they might not receive that ongoing. So it could make the business look a lot better than it really is. So first of all, obviously checking your income. Is it consistent? Is it something that's going to be continuing on after that person, after the current owner leaves? And is it something that you can maintain? Is it in an industry that will retain that sort of consistency, or do you have to plan out how much cash you might need if things do slow down over a certain period or a certain market condition? So income, number one. Then we're going to go on to expenses. So how much costs are involved in terms of running that business. What we look at next is the expenses, or the operating expenses, because essentially what we want from that income is a net profit. And generally you do have to spend money to make money. So when we look at the expenses, we're going to be looking how much is it to actually produce that income. We want it to be less than the income. And we want to, if we're going to buy a business, if we can see opportunities where we can actually reduce costs, that could be an added bonus, and we can actually reduce the price we pay for the actual asset that we'll end up with because we make those improvements later on. So if people are spending too much and you don't believe that it is needed, then that could be a good opportunity for you to see a higher potential for that business. So obviously taking that into consideration, but acknowledging that perhaps things might not change, you might not be able to get rid of that expense once you actually get into the business. Overall, income and expenses are two pretty important things. The final result, we want that income to be much higher than the expenses. Obviously the higher the better, because that means more profit at the end of the day. So the profit and loss is essentially, what did we make? How much did it cost us to make that? And other expenses that we had to pay for during the operations of that period. So whether that's a month, a quarter, or a year. And obviously for the profit and loss, you do want to see previous years to make sure it's stable or growing. If things are reducing year over year, so for example the net profit is lower each year you go through, obviously that's going to present some potential issues that if that decline keeps going on, obviously your asset's going to be worth less and less. And by asset, I mean the business itself. If it's growing, if that number is growing each year, your net profit, obviously that's a really good thing. If you can keep that growth going, perfect. If you can't, at least you've got that history there to prove that there has been growth year over year. So it is a very good thing to see a lot of growth year over year. It means the business is improving, and that's obviously something that you want to keep in mind. If things are improving, that's good. Obviously, if things are declining, it could be a cheaper deal, so you could get that business cheaper. But you want to be sure, obviously, that you can turn it around, you can make decisions to make that better and start that business increasing again to increase the value of the asset, increase the income. Also want to talk about the balance sheet. So basically we've got assets, which are things that we own. That can be cash, property, inventory, people that owe us money. We've also got liabilities. So those are things like government bills such as taxes, debt, a whole range of other things that will cost you money at a later date. So essentially the business's value, although it revolves around income, you do have to factor in the assets that back it up, and the liabilities obviously kind of lower that total value. So if, for example, if the assets are higher than the liabilities, that's a good thing. So that's just a simple, quick, all right, are the assets higher than the liabilities overall? Particularly your cash at bank or your liquid assets, if you can sell those off quite quickly to cover all of the liabilities if something would happen, obviously that's a really good spot to be in. If those assets are things like property or something that's a little bit harder to sell, it's not the worst thing in the world, but obviously it's going to be much more difficult to produce the cash to cover some of those liabilities if you do have to pay them. One thing you can look for in the balance sheet is the aged receivables. So the aged receivables are amounts of money that have not been received from your customers to date. So for example, if somebody's on a finance option with you or with that business, then you could potentially go in there, while it's an asset, you can go in there and convert that to cash by getting the customer to pay. So that can be a really good option. If they've got huge aged receivables, you can potentially use that to your advantage to say, well, you guys are having trouble collecting the money from your clients, which will obviously reduce the value of that business in a way, but it will also give you an opportunity to increase the cash flow and increase the net profit at the end of the actual year on a cash basis. So you'll increase your cash effectively. So you've got income to actually cover the expenses that are coming through. You want to make sure it's sustainable and reliable so that you have a lot of pressure taken off you. You've got money coming in that can cover these expenses that are coming up, and that at the end of the expenses you will have a net profit amount, which is the actual amount that you have as profit from that business after all your expenses. Next thing obviously is assets. You've got things that you own that are worth money, and you want those effectively to just be higher than your liabilities, and that's about all there is to it. Obviously each account, which I can go into if people do request it, each account has its own little different aspects that will have different meanings. So for example, if you have a commodity in your balance sheet, let's say you've got 1,000 litres of oil, the value of that will be fluctuating depending on where oil's market price is right now. It could go up, it could go down. So for example, if you're looking at buying a company that owns a commodity or something that fluctuates in value to quite a large extent, obviously that could provide you with an edge where if things are quite cheap, so for example, if oil was at a very low value, and you expect that to go up over time, potentially that could be another side to owning that asset, potentially gaining some more value when the oil price goes up, for example. So that can work with any asset that people have. So that might be property in a good location that's potentially cheap. It could be funds under management. It could be a whole range of different things. Foreign currency is another one. So if a foreign currency that they own is quite cheap right now, that could be beneficial to you if that currency does rise in value. So that's something to keep in mind. Also, those things can go down as well. So be really cautious if things are overpriced right now and they're factoring that into the business valuation. Obviously, be really careful with that. When it comes to income, obviously, if you can find out more about how that income is derived, so you don't want it to be a research and development grant or something that's once off potentially. You really want to make sure it's stable. That's a really good thing to do. Next thing, can that money pay for everything, pay for the loans, pay for everything that you need to cover, and still have some money to go? So obviously, if things get tight, you want to have some cash available to get out of a tricky spot, to not feel pressured. For example, if things start to slow down, you need to pay for more marketing. You want to be able to do that without too much pressure of thinking, all right, if I do this marketing, it doesn't work, then I'm going to go broke. You really want to have that extra cash up your sleeve if you do fall into that position where you need to make a decision to increase your business function, because if you stop spending money, that can create an issue too. So obviously you're saving some money, but you're not getting the new business, then you're back at square one. So keep it simple, guys. I don't want to sort of overwhelm you with a range of information. So basically we've got income, make sure it's enough to cover everything. You've got assets, make sure that's enough to be more than the liabilities. That's effectively what we're looking at. Obviously you don't want things that could turn into liabilities. You want to make a safe investment, so you want to make sure you've got enough cash, you've got enough assets to cover everything in terms of the negative side. Two simple equations, guys. Income, take expenses. Income, take expenses. The other one is assets, take away liabilities. One other important thing to look at, guys, is how much is the owner taking away from the business. Obviously that's going to be an important number to determine the actual profit. For example, if you're not planning on working there, you're planning on paying somebody else, that might not be your income. So it just depends how you're going to structure the deal, structure how you're going to do things. If you're going to work that same role and it's that same value, that's great. It's important to factor in that potentially if you don't work that job and you pay somebody else, to factor that into obviously the net profit. Is it going to negatively affect you if you pay yourself more? It's obviously a bit of an important thing, because sometimes that could be higher than some of your expenses that you normally see, because it's the owner and they've got their own thing, they've got their own reasons to be in business. So obviously checking how much are the top management guys earning. Potentially, if they're not necessarily needed as such, that could be a really huge profit amount for you. So one other thing I want to write up is owner income. Owner income, sometimes known as drawings. Basically, this is what the owner is taking from the company or getting paid as, for example, a director. Basically, this could also almost be seen as net profit. It's just effectively taxed in a different way. So the owner, if you're looking at, say, generating $100,000 for yourself a year, and the owner income is $100,000 a year, but your net profit isn't $100,000 a year, then obviously if you're that owner, you can earn that money. It doesn't have to necessarily sit as profit, so it just really depends where you want your tax to be sitting, and obviously how you want your business to look in terms of a net profit value. So that's up to you how you want to structure it, but just be aware, obviously the owner income could be your money if you're the sole owner. So it's important to have a look at what are the directors and the board earning. There could really be some extra cream in there after you have a look at the net profit, but if that's your money, kind of adds to that net profit in a way. So just something to be aware of, guys. Anyway, I hope you guys learned some stuff. Hope it makes it a little bit easier. Obviously there's a lot of accounts to cover. They all have different meanings, different reasons why they sit there, but if you can kind of remember, how much money am I getting? How much is the business actually worth, sitting in cash or assets overall, and how much is the owner getting? You've got a reasonable idea, and from there, obviously, if the business is not making much money at all and it's actually spending more money, there are plenty of great opportunities out there. So potentially you just want to find the ones that are earning plenty of money or that have plenty of assets to cover all of the stuff that you're looking at. Anyway, guys, thanks for watching this. I hope you guys learn a bit. Any requests, let me know. And if I have the knowledge and if I understand what the question is and how to actually answer that, I will definitely do a video for you and try and help you learn as much as you can. We're all here to help each other. If you guys have any input about these types of things, the ways you look at different financial statements, please let me know in the comments. Obviously, this is a quick and simple way. There's many different ways you can actually look at the financial statements, little different things that you might look for, other things that might stand out as an issue. Let me know, let the other guys know that are watching this, because that will really help everybody, and hopefully we'll grow and learn as much as we can through this video and through the comments. So it's not just about me, it's about you guys. Have a great day. Thanks so much for watching, and we'll be in touch next time.